good morning. Comment allez-vous? How are you? Welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical analysis and fundamental analysis with the overriding goal of putting together trade plans. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk your money, cannot afford to lose. My name is Wayne. I'm a currency trader like you, just like you. I've been doing this for about 20 years. In the first seconds of my morning, I am looking at the markets. I do stuff like this. I grab my phone and I go, pa-cha, and I look at the charts. First thing. I was laughing at myself this morning because I haven't even, I woke up and I haven't even gone to the bathroom yet and I'm already staring at the charts. And I'm like, how funny is that? So anyways, that's the absolute first thing I do. And honestly, one of the very last things I do before going to bed is I look at the charts and I go, oh, cool. And then I put it in the charger and off I go to sleepy time. And then honestly, most evenings while I'm sleeping, I dream of trading. I really do. It's not a joke. I'm not overstating that. So I like what I do. If you study successful people, one of the things they'll probably tell you over and over and over and over again, love what you do. Well, I love what I do. And so therefore, the passion to dig deep, to find information, to answer the question why, probably comes more from a passion than a penchant for pain. So anyways, I love what I do. Thank you for being on the ride with me. This thing we call Forex is a difficult journey, but it's well worth it. If you can survive, then it's well worth it. So how do you survive? Don't focus on getting rich this year. I want you to compare your capability, let's say your maximum potential right now. What's your maximum potential as a trader right now versus the maximum potential as a trader 10 years from now? Well, 10 years from now, you'll have 10 years of experience. You'll be much better technically. You'll be much better fundamentally. You'll have much better patience and discipline, because think of it, you've been actually trading for 10 years. You actually made it. You actually made it as a trader for 10 years. So imagine how good you'll be, but also imagine how much more money you'll be trading, because your account size would have grown over that period of time. The point here is I want you to try to get to year 10. And that, by definition, is not a get-rich-quick idea. But I'll tell you, your maximum potential will be exponentially bigger. So why try to get rich now when your skills are low, your understanding of the market is low, and your account size is probably low, all relative to where you'll be in 10 years. So instead of trying to get rich here in 2022, why don't you think about being that patient, disciplined, knowledgeable, skilled trader you'll be in 2032. And imagine that amazing life that you're going to have compared to what you do now. So, welcome on this journey with me. I consider Forex as a business. Yeah, Raymond's like, 10 years, it's 10,000 hours, right? Yeah, well, yeah, if you only work that much, sure. 2,000, hours, yeah, sure. That's about right. Cool. Yeah, so I look at Forex as a business. I hope you do too. And business is about sustainability and through value creation. Well, you have to start with the value creation idea first. And when I was a venture capitalist, you'd look at things like this. Okay, what is it that this product is supposed to do? Very often, out of the 100 investments that I made and probably the 400 investments my team made, right? Very few times did we make an investment and that company went on to do what the original developer thought it would do. So there's always this idea of what's the maximum value we can obtain from this idea, from this patent, from this product, from this service. So what's the maximum value creation you can create here? And it's not actually the profit today, it's your ability to predict the future. So you can help people prepare for the future and not just react to today. Okay? Okay, think about that. Your ability to predict the future is more value than capitalizing on or reacting to just what's happening today. But if that's all you could do, let's say you're a pure technician and today you make 2 or 3 trades, most of them are profitable, some of them are not, and then you close all those trades and you go to bed and you have no positions on. Okay? Is that a bad thing? No, you created value by creating profit. That's good. The problem is it's not scalable. So to maximize your potential, you need a business that's scalable. Do you understand that? And very often when as a venture capitalist, this is the 2 things you're saying. What value does this opportunity create for its customer base? Why would people use it? Why do people need it? What will people pay, for it? Well, people will pay money based on the solution, not the complexity of the product, but instead what problem does it solve? It's funny. There's a lot of wealthy people that make a lot of money on Wall Street, but they don't do anything particularly that difficult. But they just have large clients and therefore they make more money. Okay? So anyway, so what problem does it solve? So you're like, well, right? And then the next thing is, as a venture capitalist, once you figure out, you're like, wow, that solves a really interesting problem. The next thing as an investor, you have to say, how do we scale this? How do we handle 1,000 customers at a time, then 10,000, then 100,000, then 1 million, then 10 million, 100 million? How can we roll this product or service out to 1 billion people? You understand? So if you look at Forex like a venture capitalist would, and of course I bring that baggage with me, I say, okay, yes, making money every day is important, obviously, but the maximum potential is your ability to scale, which means instead of having 5 trades on and then 5 trades off, how can you get 50 trades? How can you get 100 trades? Now, market conditions may be ripe for that, and they may not be ripe for that. You might have 100 trades open on the ends, but probably not the dollar pairs. Okay, fine. But if you were going to be able to scale as a business, you have to be able to predict the future, let's say at least 3 months in advance. Santiago says, hey, Wayne, what's your advice on balancing family and your trading day to day? The number one best thing for that, Santiago, is to be able to work at home. I've had fancy offices and beautiful skyscrapers on high floors with amazing views, but the best thing is to work at home. Okay? What an amazing freedom. Okay? Okay? What an amazing freedom. So right now, one of the things I'm thinking about is it's a nice warm day. I woke up this morning and the sun rose over the lake like it does every morning. Beautiful sunrise, and I'm blessed to be able to be here and see that every morning. And then I noticed that we still have cormorants, and they were circling around, celebrating the morning sun, circling around in the water, flying around. It was really amazing. And then some herons, and then some egrets, and then some geese. And it was just, and, you know, and I'm like, but not only am I home, I'm at work. So I say to my daughter, have a great day at school. Say to my wife, have a wonderful morning. I give her a kiss, and I go downstairs to work. And then I can sit here and I work and I can trade. I can get some trades on Santiago. And then I can say, hey, you know what? I think I'm going to read some of those central banking reports. I'm going to sit outside right there. A different part of a view of a different part of the lake. I can sit outside. I can light a cigar. I can have a coffee. And I can sit there working. And I can have lunch with my son who decided to do school at home. I can go upstairs. I can hang with him. We can talk, even if it's only for 5 minutes. Okay? So I want you to think about Forex, especially in the beginning, right? I want you to think about Forex not as a way to get rich quick. That never leads anywhere because there's no value creation. You're not thinking about creating value. You're creating about getting something. It's not the right way of looking at things because it's always going to be difficult. This is a very difficult gig. But if you think about longevity over money, okay, think of it, longevity of your trading, this idea of surviving, this thing about being a currency trader 10 years from now. None of this is sort of a hurried response to whatever's happening. So if instead you think about Forex offering you a lifestyle, what's the difference between money and lifestyle? Lifestyle is a value. It's right. It's valuable, but there's not a dollar amount to it. But how much value creation is it that you don't have to spend 2 hours a day commuting, or even let's say an hour a day commuting, 20 hours a month. Okay, now you can start reverse engineering and you can put a dollar amount on that value, but that's where you have to come up with a value. Okay? Right? You get it? 20 hours. So let's say 250 hours a year, you're not driving to and from work. How much is 250 hours worth to you? But then you need a car. What does your car cost? $500 a month? Okay? And your insurance, and your gas, and your tires. And the potential risk of you getting in a car accident and dying, or being maimed, or just being in a car accident because you're on the road 250 hours a year. That's got to be a risk. And all of a sudden you can quantify that and I don't know what your dollar amount is, but you could say, well, that's worth $25,000 a year. Just that. But the idea that you'd have to re-engineer and come up with a value idea, then Forex is value, right? It is just you sitting here in front of your charts. Bare minimum is $25,000, not of profit, but of value. So I want you to think about value creation. You're serving yourself as your customer. And then once you develop a track record of success, maybe 10 years from now, you'll have customers that you are serving. But they'll come to you, though, and they'll say, hey, Susan, can you help manage my money? I'm worried about inflation over the next couple of years. And you say, well, that's good. Let's talk about inflation over the next couple of years. Let's talk about various scenarios, what could happen, what may not happen, where you're probably protected, probably where you're not protected. Okay? And now you're once again creating value, but you have to be able to think that way. So my neighbor and I were just talking about finance and economics, and he's an engineer. And he's like, man, if I would have known about interest rates. He said, I would have done something like what you did. And I said, well, I'm an economist. I know these things. It was probably arrogant, but sometimes I'm arrogant, but I knew these things. And he's like, so he could have just asked me and I would have told him. But the thing is, that's where the value is, isn't it? Okay. Lewis is spot on, Wayne. That way you can spend more time with your family and raise your children. Well, think about too. Forex afforded me the opportunity to basically take a 5-year sabbatical and go to Harvard and be a full-time student at Harvard so I could be an example to my children. How much is that worth? Well, I can put a dollar amount on it. I gave up a Lamborghini. I gave up other business opportunities. And I was a full-time student and a trader. Cool. But I hope it created some sort of value where maybe when my kids are 40, they're like, hey, man, I just want you to know, Dad, that was cool. That really was an example. Now, I'm not sure if that's going to happen, but I did it. Okay? But I did it. And could I have done that if I had a regular job? Let's say I was a trader at a bank. Okay? Like, for example, right when I first started Harvard, I put it on my LinkedIn profile. I'm like, hey, I'm going to Harvard. Well, all of a sudden that fit the algorithm. And there was a big bank here. It's now called Truist. It used to be called SunTrust here in Atlanta. And apparently, a manager went to the HR department and said, you know what? We need a Forex person. We need a VP of foreign exchange. Go find one. So the recruiter sat down, went to LinkedIn, typed in Atlanta, foreign exchange trader. And so I get a call or in an email and then a call after I responded to the email. They're like, hey, we're the largest bank in the southeast of the United States. Are you interested in being the vice president of foreign exchange? So we had this conversation. Cool, right? Now, often people ask me, is Harvard worth it? Look, that's what happened. I just mentioned I'm going there. I hit the algo because obviously they put in Atlanta, foreign exchange, Ivy League assholes. And Harvard came up. Cool, right? It helped me match. So anyway, let's say I took that job. Okay? I wouldn't have had, assuming I would have already had my degree, right? Like if I did the normal path. So if I was vice president of foreign exchange for that bank in Atlanta, I'd be commuting. Okay? I'd be commuting to work every day. There's my hour a day minimum. 250 hours a year just to go to work, plus the cost of my Bentley. Okay? Plus the cost of the insurance on the Bentley. All that kind of stuff, right? All of a sudden you're like, dude, that's 50 grand a year for the privilege of going to work. Plus I wouldn't have been able to take the time off. Plus I would never get to spend time to pick up my children. So my daughter this morning said, hey, Dad, can you pick me up at school? Yeah. I just yeah, not a problem. Yeah, I'll go 3:30 in the afternoon, not a problem. Okay? So you see the compromises? I wouldn't have been able to do that. If I was a vice president of foreign exchange for a giant bank in Atlanta, I'd say, sorry, honey, I'm not going to be home till 8 o'clock. So if you look at Forex as a lifestyle that offers value, then you would protect it more than gamble to make money. How do you make money quick? You gamble. What do people do when they have very little? They gamble. It's human nature. It's in the psyche. If you have nothing to lose, you'll risk it all. And then when you have lots to lose, you'll protect everything. Okay? So be very, very careful. If you're starting with a small account and you're trying to get rich quick, it's not going to happen. And even if you double your account, you're going to destroy it too, because you're in this process of gambling. Instead of looking at money, you look at value creation, and you look at lifestyle and not account size, and you focus on 10 years from now, not today only. And you say, well, how do I create value? Well, you look at economic data and try to predict the near future, so you're always a couple of months ahead, and you can explain the reasoning and rationale behind your trading, and maybe you can take that ability to look forward, your forward guidance, and you're able to scale it a little bit. Then you're able to create so much more value, and you're going to be amazing 10 years from now, because you'll be patient, you'll be disciplined, you'll have real skills, you'll have scalability. You will be an amazing contribution to society. In particular, your closest community. You, your family, your friends, your neighbors will all look up to you and maybe even rely on you. And then, once your account size does get bigger and you buy your fancy cars and your watches and all that shit, then you'll move on to legacy. Because you'll have this hole in your heart. You're like, I've always wanted to make it big, so I want to get a fancy watch. I want to get a fancy car. Great, good. Go ahead and do it. And then you're like, you know what? That actually doesn't make me that happy. Then what do you start doing? You start focusing on legacy, like being a role model to your children. Not only by what you say to them, but two things. What you do, and just being there. And you'll say, oh my God, that's what makes me happy. That's what fills, if you have a hole in your heart, that's what makes you complete. Being around your legacy, your children, your grandchildren, okay? And providing for that legacy. And changing the flow of your lineage. If you grew up poor and your grandchildren are raised rich, you've made a shift. You did the impossible. You diverted the Nile. And that lineage can continue on for generations and generations and generations. Well beyond. Think of it. 5 or 6 generations now, there'll be oil paintings around the grand dining room, the grand hall in your great-great-great-grandchildren's house. And they'll have oil paintings of you above the fireplace. That's great-great-great-grandfather Lewis. He changed everything. Yeah, Matosa, yep. All right, cool. All right, that's that. Soapbox removed. Well, thank you, Susan. Tell everybody. Okay, so. Right on, Golden Surfer. Well, yeah, I thank you guys for leading these conversations. Golden Surfer. Now that's funny. Yeah. All right, cool. So let's take a look. Let's do a quick look around the world. Okay. Yen all over the place. Dollar all over the place. Swissy up. Okay. Cool. Let's start with Swissy pairs today. Okay, you can't start with Swissy until you do Euro Swissy. And this is the trade we have set up. Be interesting if it can follow through. You almost have a second chance potentially. But you can see we already picked the bottom here. Okay, this is 101. Actually, no. Hang on. This is farther back than that, right? Yeah, 101. Sorry, 101. Okay, 102. 382 Fibonacci retracement. Okay, and now the idea is price action up to 1618, which let's stretch that a little and just say 103. Jim says 10-year knocking on the door of the 3 handle, and also watch the 30-year. No. Okay. Well, JR wants to know more about distribution. Well, think of it this way, because distribution has to do with, there's many ways of looking at it and calculating it and describing it. But let's, one way you might want to look at it, I mean, it depends on what market you're talking about, but what if you converted it to like breadth? Not only is the stock market going up in places, like some stocks are going up, and well, some stocks will go up and some will go down, but what if the broad market, so let's say the S&P 500 is generally going up and you believe trending up? That's as far as we kind of want to go with Forex. Because the stock market going up doesn't do anything for a Forex trader unless foreigners are buying it. So that's why you want a long trend where foreigners say, you know what, we need exposure to the U.S. economy. It's the largest economy in the world, and it seems to be in a bullish trend. Therefore, we should buy some U.S. stocks. Okay? So everything kind of needs to look attractive. More realistically, what was most attractive to foreigners were bonds. Right now, bonds are falling. Okay. But what we're trying to ask, generally speaking, is risk on or risk off? Okay. This is a sentiment idea. Okay. That's why, right? So anyway, so that's as far as we kind of want to look. So you can use the S&P 500 to do that. You could look at yields, see bond yields, okay, or treasury yields, okay, T-bills, T-bonds, it doesn't matter. I'll put T-bills just as, right, okay. So what you want to see is if these rates are going up, okay, in a normal, healthy world, okay, but whatever that means. But in a normal, healthy market, this should be going up if the stock market is going up, because that means if yields are going up, the bond market is falling, and the bond market is a risk-off play. See, if you're afraid of having your money in the stock market, you take it out of the stock market and you invest it into bonds and T-bills. Okay. So if that happens, interest rates are falling. Think about what happens when the stock market's crashing. Okay, interest rates are falling. The Fed's probably cutting interest rates. So rates go down. Well, rates are going up, which means people are taking money out of T-bills. They don't want to own T-bills. They want to own the S&P 500. And you're like, yeah, but wait, that's happening, right? So, right, these are going up, which means the price of T-bills are falling, but the stock market's falling too. Okay, great. You're totally right. What's going on here? Well, what's your outlook for the S&P 500? You need to have an outlook. If you get that right, you've created value. So where's the stock market going to be at the end of the year? Pretty simple question. You should be able to sit down and explain it, even draw the chart. But then you're like, but if the S&P 500 is going up, or no, if the S&P 500 is falling now, why are T-bills falling now? So you have to explain COVID, its impact on the market and the economy. Okay, what the Fed did, what the White House did, and what they're doing now, and where we will be in the future. Okay? And so you would then, in my opinion, I would then do this. Okay, S&P 500 is falling. It will not continue to do so. T-bills are falling. They will continue to do so. So at some point, my value creation would be a play like this, where I say, yeah, both are going down now, but this will happen. And if I'm right, I've created some value. Okay? So, right? So in that case, what you could also do for a risk-on, risk-off assessment is look at like Bitcoin. Okay? Okay? Because that's definitely a risky asset. And if people are buying it, then they feel like taking risk. And if they're not buying it, they don't feel like taking risk. Risk on or risk off. Now, someone might say, well, you can be a little more sophisticated and you could look at the distance between the 10-year and the 30-year. So the difference would be the 30-year yield minus the 10-year yield. Okay, and that should be a positive number, right? 2.99 minus 2.9. Well, let's say 89. Okay, gives you a plus 0.1. So right now there is a positive yield or positive difference, right? The differential in yield between the 30-year and the 10-year is 0.10. Well, that doesn't mean anything until you say, well, what is it normally? And how does the spread between the 30-year and 10-year change? And what circumstances create those changes? And then you could then say, well, that's interesting because these are long-term investments. Well, what about the 2.5? Okay. What do you call the 3-month LIBOR? 3-month LIBOR minus the 3-month Treasury yield. 3-month T-bill. Okay. What do you guys, what's the name for that? 3-month LIBOR minus the 3-month T-bill. TED spread. Exactly right. Now, back in 2008, 2009, 2008, I was in New York, and that's one of the topics of my presentation was what the TED spread was telling us. Okay? But nonetheless, okay? If you're looking at the 2-year and the 5-year, and this is going up a lot and this is going up some, what does this tell you? We have a lot of inflation now, and rates are going up based on that idea, and we're not so sure we'll have inflation later. These are balloons. And the balloon, they say, over the next 2 years is going to be inflated more than 5 years from now. And that's one way of reading that. So in that case, if interest rates went a lot, if the yield went up a lot here, but not so much there, the spread would narrow. If the market thought inflation was going to be even higher in 5 years, then this would go up even higher, and the spread would widen. Okay? So think of it this way. In a normal market, okay, let's try to say, if interest rates here on the 2-year, let's say the yield on the 2-year was 2%, and the yield on the 5-year, okay, more than double, should pay you at least double that, right? But very often not. Let's just say 3%. Okay. What should the 10-year pay you? Certainly 4%, maybe 5%, right? Well, what about a 30-year investment? Right? Probably at least 5%, right? But you could really argue, boy, if this is 2, this could be 4.5. Okay, this could be 9. And what? This should be 27%, right? So, right, the longer you invest, the more you should be compensated, right? But that's right, that should be generally true. But then what kind of factors go into these decisions? Okay? A 3-month investment, for example, has different risks than a 30-year. And the different risks should be compensated accordingly. And so what some investors are trying to read is, well, risk is reflected in price. If you're taking more risk, you should get paid. And there are 2 ways to be paid. Okay? You either earn a higher return or you pay a lower price. Okay? For example, Ford Pintos, okay? Let's say whenever these were out, 80s, 1980s? Let's say you were going to buy a Ford Pinto, and right? And you're going to buy a used one for $5,000. I don't know if they were ever $5,000, but this is a car from the 1980s. So you go to buy them for $5,000. Then the news comes out. Apparently 4 or 5 of these cars around in different parts of the United States exploded when they got into car accidents when they were rear-ended. So what happened was someone was driving down the freeway. They had to slam on the brakes. The car behind them hit them from behind, and the Pinto exploded. Boom! And people burned alive inside their Ford Pintos. Okay? So the risk of owning Ford Pinto went up. So what happened to the price, the value of a Ford Pinto once this news came out? It went to zero, right? Well, that can happen in a bond. Okay? The price can fall. Okay? The other way of doing it is, okay, if the government can't attract investors on 30-year treasuries, they can raise this to 3.5%. And someone will step in and buy them. Okay? If you own an existing, if you own an existing 30-year treasury, let's say you bought it last year, and last year it was paying 1.5. No, that's not right. 2.0. Let's say 2. Okay? Remember, you buy a bond and it says this is good for 30 years, and every year you'll collect 2%. So now there's 29 years still left on your bond, and you decide you want to sell it. But you can buy one right now that pays you 3%, but you're going to sell a bond that has 29 years left at 2%. How do you sell it? You lower the price. And you can do it mathematically, so it calculates to this 29 years if it were paying this, and you can backtrack everything, blip, 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 and you lower your price. Okay? And then if interest rates go even higher, you'll have to lower your price on your 2% bond even more. Okay? Cool. All right, cool. Nice, right? All right, going back to this, here's the trade plan we did in the day trading group. In fact, we might have done it this way. I just noticed this. Okay, that 618 predicts this, actually. So it's kind of interesting. So right now, the decision you need to make is whether you're going to buy this. That's the only decision, is will you buy the high or low? Okay? And I just do this. No, 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 no. So, if you believe, we put a man on the moon. Man on the moon. Okay? If you believe this is a higher high, then that's how you're going to play it. Man on the moon. Cool. You guys want to talk commodities? All right. Okay, lots of interesting things going on here. You know what those two X's are? Well, we talked about them yesterday as being buying prices. Okay? So this is kind of what we're looking at to connect the X's. Okay? Cool. This might be good. Okay? If you believe. All right. Why did gold fall? Do you know what that says? It says this price right here. 1964.7. Not that that's the low. Okay? That's not what it says. But it says often it will fall to that price. Then what the training course says is from here, all bets are off. We're back to, I don't know, neutral. It depends on other things, right? Like this trend is straightforward, but in the training course, because not just of the price, but also the time. Okay? How many people can confirm this? In the training course, it says in this situation, we come back to this price. Like how many people have that in their thought process of that is a very plausible response that we, in this situation, we reset on that price. Okay? It doesn't explain why it happened. Did something fundamentally, okay? It doesn't fundamentally explain anything. That's a technical scenario. And it's amazing how accurate the price is. Because remember, we had that price set here. Okay? Now, does it always do this? No, but you always are prepared because you know this leads to an if-then statement. If this declines from here, then you have a target in mind. And that target is right there, and it's already spelled out, 1964.7. Okay? And then in the training course, it explains, okay? But I'll leave that for you to take it. $88 a year, by the way, to know stuff like this. Okay? Cool. So anyways, all right. Okay, here's our Bitcoin. Okay. Okay. Now we set this up 2 days ago. So let me explain tomorrow. Okay. I drew this line 2 days ago. And now, right, with the idea of if we breach, then we get, and then if we get that, then we get that, and then if we get that, then we get that. And if I get this right, I have created value. Because we actually talked about this falling down, falling up, falling down, then making the big move, then the counter move, and then the opportunity. And we did that like way out here because we were kicking off this 21, kicking off that. Okay. We had kicked off this 21. So we'd kick off that 21. Then we'd hit this. Then we'd do that. And then we might do this in the near future. And then if we do that, boom, which means 2 or 3 days in advance. And that would be value creation, not just opportunity capitalization. Okay, that's good. Pure technical analysis is great because you're capitalizing on current market conditions. Okay? That's good. You are creating value. But then if you can predict tomorrow as well as today, you'll create more value. Because, for example, you could plausibly let your winner run. If you had the encouragement, it's like, for example, if you were here, you could possibly exit there at resistance. Okay? Did you create value? Yes. But if you analyze this and said, well, I'm in at a pretty good spot, and if I can survive this pullback and make a higher high, I can get to the mean. Which is what? From here to here, value, so we'll call the value X, okay? Do you create value by letting it run more? Yeah, 3X, by letting it run a day or two more. But if you're heading here, okay, it might be 10X. And if you're going to let it run all year, it could be 100X. Because you could see a full year in advance. You're like, I'm buying it at 40, but I'm going to let this run to 100,000. And you're saying, well, Wayne, that's not 100X. No, relative to this original move. Okay? If this day trade, okay, if you could, instead of holding it for a day, you held it for 365 days, you have 365, let's say, X, if, of course, it rallied up that much. No, it probably wouldn't, but certainly 100X is possible. But here's my point. It's the same amount of work. So why do you earn more money if you're not working more or working harder? I want you to think about that concept. How does an Uber driver make more money? Work more hours, drive more miles. Okay? Now, let's say you're a professional and you have a college degree. That's not how you get paid. You have a salary. Okay, let's go into that. You're the vice president of blah, blah, blah for XYZ Corporation. How do you make 10% more money? Let's say you're not vice president. You're just in the marketing department or something. I don't know. You're right. How do you make more money when you have a salary? Well, every 5 years, you can go to your boss and beg for a 5% raise because inflation is higher. Or you could quit your job and go find another job and make 10% more money. And you might that higher level job or that higher paying job might require you to work more. So you're still not really benefiting. Right? You either work more hours, right? Or you do more complicated work. But it's very difficult to make more money. You maximize. Why? If you have a regular job and a regular salary, to double the amount of money you make will take 10 years. It's still more time, right? To go from a $100,000 job to a $200,000 job. Or if you're driving with Uber or you're a lawyer, how do lawyers double their income? Work twice as many hours or raise your fees. Either way, then it's harder to get clients, so now you're not working as much. So let's go back to this idea. Value creation. Once you've made this decision and you've pulled the trigger, that's done. The value, because that's right? The difficulty of pulling the trigger is very low. You can just pull the trigger just randomly. You can just randomly, every day at 8 o'clock, you buy. Done. And if the market's going up, that's good enough, son. Think about it. If we were in a trend that was going to last 3 months, and for some reason you know this, then every morning at 8 o'clock you buy. That's good enough. Did you ever think about that? Good enough. It's going up for 3 months. Every day you buy it. So the buying part is not the difficult part. So what's the next? How do you create more value? Well, you either just trade more, buy, or how about this? Because if you're buy out, this is scalping, right? You're not creating any more value. You're just working more. You're making more trades. But what if you created value simply by not exiting? Okay, a 20 pip trade turns into a 100 pip trade, 5x. A 20 pip trade turns into a 200 pip trade, 10x. Well, what's the difference between a 20 pip trade and a 200 pip trade? I want you to think about that. How can you create How can you create 200 pip trades? You're going to need to think beyond today, most likely, right? Now, it's not all about that. You still need to be able to trade well. And those that have mastered smaller time frames, I think, have a massive advantage, because I think you can eventually learn about fundamental analysis, macroeconomics, trader psychology, behavioral finance, all these things that go into what we do. Like Peter, right? Peter just says, yeah, let your winners run. Well, you can't let them run if you can't do that stuff. So in the beginning, you really do need to master being in on these trades. And then, of course, in the near future, potentially this beautiful trade. But then the next part, which you will need to work on for the next 10 years, it's like going to school to get a PhD. Your PhD will simply be how to turn a 20 pip trade into a 200 pip trade. That's it. That's what you're going to work on the next 10 years. Once you learn the basics of trading by mastering technical analysis, the next thing is, okay, you're pretty reliable. Okay, let's say 50% of the time, or let's say 60% of the time you get your 20 pip trade. Cool. You're profitable. Then the next point is this. How many people think you'll make 10 times more money if you learn the difference between 20 pip trades and 200 pip trades? Okay. Hang on. It's a little bit of a trick question, but I'm trying to get you to think. Okay? Hang on. What does scale, when I say scalability, what does that mean? If each trade is worth 10x, okay? The interesting thing is you're able to add to that position, add to that position, add to that position, add to that position, add, right? Where, okay? What will happen is you'll make a lot more than 10x. Because what will happen is you'll build your positions, you'll earn things like swap, but you'll end up actually having more trades. Okay? Or you'll work, let's say, let's play around with the lifestyle idea. What if you only made 3 times more money? Okay? And you worked 0.5, okay? You work half as many hours. I know that doesn't even compute. The reason I'm doing that is to say, well, to get that, you might give up. You'll give up some of your winners. You'll make 3 times more money and work half as much time. You'll leave some money on the table, but you also have more time to spend with your children. You spend more time outside. Okay? You spend more time working on your 1967 Shelby Cobra restoration project in your garage. And that makes you happy. You spend more time at the museum. You spend more time at the homeless shelter. You spend more time with your dogs. Okay? Richard says, that's what I found to be more logical. Instead of looking for more trading ideas, just, right? But my point here is, or part of my point is, if you know when your trade is worth 200 pips, or you think it's worth, and you try, okay? Then what that means is those trades are more valuable. Okay? You're creating value. Okay? You're bullish on value creation. You're a value bull. Okay? James says, is this a concept called pyramiding? I don't like that language. It sounds like get rich quick bullshit. Okay? The language I use is it's a portfolio. Because you are thinking 3 to 6 to 9 to 12 months in advance, you're like, okay, over the next, between now and 5 years, you believe the stock market will go up. Then what you're buying now, you're going to hold for 5 years. How many people think the stock market will be higher in 5 years? It's a yes or no question. How many people think the stock market will be higher in 5 years? Now, I'm not even asking you why, and maybe we agree on why, maybe we don't agree on why, but just a basic concept of you predicting the future. Oh my God, you're predicting the future. Okay? So what would you do now about that? Okay? How many people here own real estate? If you own a house or an apartment or housing, okay, you bought it at some point, okay, you bought it at some time ago, and by doing so, you are stating, okay, when you sell it sometime in the future, the price will be higher. Otherwise, why the hell would you have bought it? You understand? Oh, I want to buy the house, but I think in 10 years it'll lose money. Nobody has ever done that on purpose. So all buyers of real estate believe there's some upside value over time. Cool. But you can't do that for Forex? Why not? Okay. So again, I'm challenging you to think not completely different, but just a little further out. It's a message I keep giving you. Think a little further out, and I think you will find more. Okay? So don't stop what you're doing. Okay? But build on what you're doing, and your trades will become more valuable because you're in the process of making decisions. How do you make a decision? If I asked you, why do you think the stock market will go up over the course of 5 years, you'll probably give me some rationale. Why did you buy that house? You'll probably give me some rationale. Okay? So as you develop an opinion for Forex, you will have some rationale for your opinion. And that is the most valuable part of your trading. How did you get to the conclusion? Which means you've made a decision, which means you're in control of your trading. You're not reacting to the market. Oh my God, oil just fell. Everybody sell oil. Oh my God, look at gold. Oh. And instead you're like, well, dude, it kicked off the M4. What the hell were you thinking? Of course it fell. It's Tuesday. And we're slamming into M4. Like, what did you think was going to happen to gold? Oh, I thought it was going to go up. Why? I heard it on CNBC. Really? Oh, I read it in some guy's newsletter. Uh-huh. Well, if you buy gold at weekly M4 on a Monday night or a Tuesday, you just had a learning experience. Okay. Richard says, how do I master technical analysis like you if I have 20 years of experience? Well, I probably haven't gotten any significantly better at technical analysis in the last 18 years. Probably about the same. Okay. If you watch my videos on YouTube from 2006, I think I got some here. Let's do this. YouTube.com/FXBootcamp. Let's find one here. Let's do one from 13 years ago.
Welcome to the presentation for the Daily FX trading audience. You've made it to the presentation. I think there's a few chairs in the back. Go ahead, grab one, make yourself comfortable. There's some donuts and coffee.
The link is in the description below.
The topic of the presentation today is how to improve the timing of your trades. In previous presentations, we talked about how to use moving averages, we've talked about how to use oscillators, we've talked about how to use Fibonacci retracements to get into a trade. Now let's talk about Fibonacci extensions. Yeah.
So look at
by using a 20.
Look at this. This is 13 years ago. I talked about Fibonacci extensions just, 20 minutes ago? Look at my moving averages. Look at my MACD and my oscillators. I just went over this. I'm like, oh, look, a 618. That predicts a 1382. Okay? Dude, that looks like the chart we just did. Anyways, look, my technical analysis has not changed in 13 years.
And you're losing angle and separation between the 2155. You've been pulled from neutral to down. So in any case, we get a downward action. Price waits for the moving averages to catch up, and then all of a sudden it kicks down again. So anyways, here we're getting.
Look at that. Nothing has changed since I made this video 13 years ago. And I'd already been teaching this process for years and years and years and years and years and years and years. So you will become a master in technical analysis in the next 2 or 3 years. You'll master it and you'll be done. Okay? Okay? Isn't that cool? I like King. King's like, I'm aiming to be a professional by January. Yeah, knock it out, be done. Yeah, well, look, it's a never-ending journey. Okay. So, cool. Susan says, the key to success is to be the turtle, not the rabbit. Well, I want to go back to this idea that it's not a journey, it's an existence. I want you to think about it that way. It's not a journey. I don't care if you're a turtle or a rabbit. Okay? Just be. Just be a currency trader. Okay? And focus on surviving. Okay? The greatest thing I ever did as a Forex trader, and I'm certain I talked about it in my book. I'm not certain, actually. I think I did. The most important thing happened early. I just quit my VC job. I must have been 6 months in, maybe even less than 6 months, 3 months. 3 to 6 months in, I don't know. Early, it was early. I just quit my job, gave up benefits and a salary and all paid vacation and dentist and doctors and all that kind of stuff, right? And I started trading all day, well, actually all night. So I'd start work at 10 o'clock at night and I would work until 10 o'clock in the morning. And I very quickly ran into challenge. I wasn't performing as well as I was when I was trading part-time. I did worse trading full-time. And I'm like, uh-oh, this is a problem. So I went on a business planning retreat with myself. I went to the Ritz-Carlton in Half Moon Bay for several days. Cool. I even had an outdoor fire pit so I could sit and drink and smoke cigars and do what the Wayne do. Okay? All right. So I had a business planning retreat with myself. Now, I used to run a company of thousands of people. Then I ran my own companies, and then I was a venture capitalist. So naturally, I want a strategic and tactical plan. I need a business plan. And so I sat down and I probably worked hours and hours and hours on the idea of what is my mission? What is my operational direction statement? So my mission statement is like, why do you do what you do? Or what is it that you do? Okay? And then the operational direction statement is, how do you do it? And I really had to think about that, because what I was doing was I was trading every day trying to make as much money as possible. But I'm like, there's no business on the planet that says, well, everybody just do your best and we'll see what happens. It just doesn't work. All right, so I'm like, so why would I trade like that? So anyways, mission statement, operational direction statement, my ODS. Okay, great. So I was standing there, and then I'm like, well, if I was a business, I'd do my KRAs, key result areas. Now, the interesting thing is when you go to B school, the mission statement and operational statements, they've kind of switched around a little bit, and KRAs are there's different acronyms for everything. But the point is, in business planning, you have to have clearly stated goals. And then you have to have a strategy to achieve them. So I thought, well, my God, well, what is my goal? And I thought, well, is it to make, let's say, like $1 million a year? Well, how would you do that? Okay. And they're like, I'm going to need an Excel spreadsheet. So you bust out the Excel spreadsheet, and now you're doing your real work. Your real work. God's mission, if you will. You're like, oh, wow, I got to reverse engineer this whole thing. And you start asking yourself the right questions. Well, what do I need to do every day? How many trades am I making? What's my winning percentage? What's my lot size? Oh, in context. Not just what are they, in context to what? Well, what's the goal? So I started working on all these really interesting questions, and this took days. Okay? I even had a board meeting with myself. I had an agenda for the board meeting, and I even had somebody call in for the board meeting. So it was all documented that this was business, right? But here's the interesting thought or process where I reverse engineered, where I'm like, again, I'll pick a number, $1 million a year. And then I say, well, what's my winning percentage? Oh my God, now I got to go figure that out. And then, well, what's my average lot size? Oh my God, I got to go figure that out. Well, what's my average stop? Where's my, so I have to define risk. Where do I normally put my stop? How big is that? I'm like, I had to keep going back. Every time I asked myself a question, I'd ask myself one question, and it'd be 8 hours worth of work. But then I started gathering this intelligence, right? And then I finally had enough of the variables identified that I could start plugging in some numbers. If I traded with these variables every single day, day in, day out, day in, day out, day in, day out, day in, I calculated how much money I'd have at the end of the year. And it was $100 billion trillion. It was so beyond the target. You know what I just learned? First of all, I knew who I was as a trader, statistically speaking, but I also found out probably the most important lesson ever is I had way too much risk. Okay? Okay? Well, Sultan, if you're going to log in and insult me, I'm not going to answer your question. Simple enough. Okay? But here's the most important thing I learned. It's not that I was over leveraged, which I was drastically. But you know what dawned on me? After pondering and thinking so hard, and I'm not joking, 30 or 40 hours of working on an Excel spreadsheet and like asking questions. Well, what is my average stop? Oh my God, now I got to go through all my trades, right? I figured myself out. I figured out I was over leveraged, but I'm like, who cares if you're over leveraged? Do I care if I need to make if I make $100 billion trillion? No. I want you to think about this. My whole entire shift occurred right then and there. It dawned on me. You could almost like a gong went off. Boom! I can lower my leverage drastically. And now what? If I just follow the plan, in 1 year, I will achieve my goal. If I just follow the plan, at the end of the year, I will achieve my goals. I know that's what business plans are, but I'm applying it to trading. Like, I don't have to sit down and try to make as much money as possible today. I just have to achieve this basic, simple daily goal. My minimal acceptable performance. Oh my God, I just need to be mediocre. I don't have to try that hard. I don't have to take giant risks. I don't have to have this pressure. I just need to show up and do the job. Oh my God. And I'm telling you, everything changed. And that, again, is value creation. When you think of it, my job is to just be okay every day over long periods of time, do okay, and the account size will grow. That was just one part of, that's just one of several just mind-blowing events that occurred at that business planning retreat. Understanding myself as a trader, but understanding trading as a business. Okay? Incredible. Absolutely, totally incredible. Yeah, we can check the stock market. Let's do it. Okay? Go to tradersway.com. Okay? Click on empty web. Okay, now that logs you into MT4. You got to go over to MT5. That's easy. Look how quickly that was. Okay. Now the other interesting thing is, watch this. I have this little pop out. Is it floating player that does it? Yeah, check this out. Now I have it over here. Look at that. Now there's no web page. Now it's just platform. And it floats, which is amazing, right? Okay, and there's the stock market. And there's my plans from several days ago. You see this? This is what we talked about on Monday. Shalakalaka. Boom! I kicks the flavor like Stephen King writes Hoa. Yeah, somebody actually wrote that. Jump, 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 jump. Everybody jump. Cool. Sultan says, too noisy. Okay. You don't know me, so you don't know what I'm doing. So what you're saying is you don't understand, which is fine. Okay. I'm only using 2 layers of pivot points. Okay. Okay, Sultan? I'm only using 2 layers of pivot points, and I'm using some moving averages. Cool. Am I using all of them at once? No. Okay. But if I were to clean this up for you and simplify it, let me do it this way. Let's say I'm a bull on oil. WTI. This is just WTI. All right, let's say I'm a bull. I would go to, right, a weekly swing trade bullish bias, for example, which means this week I'm a bull. I'm not telling you should be. I'm not saying this chart even says it. I'm just saying you show up today and you're like, I'm a bull on oil. Okay? So I would move this. I'd go to swing trading bullish bias. And let's say you don't like moving averages. Okay? Or let's break this down. You only care about trend, market, and price. Trend is the bigger picture of market and price. Okay? But you don't need so much data here. Okay, great. So let's start by cleaning some of this up. If you're going to use a weekly pivot point as your market, you don't need market moving averages. Now, I have them. It doesn't bother me to look at them. But let's say they bother you. Okay, good. You don't need them because we have multiple ways of making that decision. Okay, cool. So now that we have this, now I only have pivot point, weekly pivot points. And by the way, because I have them set on bullish bias, I only have the pivot points I care about. Now, trend I don't need because of what? Well, I'm using trend lines. Okay, actually, we're looking at a mean, which is average, a trend in the mean, which is slope. Okay? Okay? So if you care about average, it's 1 plus 2 divided by 2, okay, which is 1.5. Oops, that's supposed to be, that's my mouse, sorry. 1.5. Okay, that's average. But what we care about is, was this a 2? And is the next one going to be a 1? What does that tell us? Rise over run. And that gives us a slope to the average. So this slope is negative, and that tells us in this period, the slope is down, the trend is down. And then standard deviation is a whole different calculation. All right, so my point here is if we have one measure of trend, we don't need the other one, which is this 200 EMA. Now, some people don't understand this calculation. Y equals mx plus b, where m is equal to rise over run. Okay? Y is the y-axis, X is the x-axis, as B is the intercept of the grid. Okay? All right, cool. So if you don't understand all that, well, just use the 200 EMA or the 100 EMA, whatever you want. But in this case, let's get rid of those. So now I have what? I have a measure of trend. And in this case, I'm using channels. Channels. Standard deviation channels, but you can use whatever you want. Regression line, whatever. Because it's just, regression is another way of saying mean reversion. And there's multiple ways you can do it. It doesn't matter. I use standard deviation because that's what I learned at Harvard. Okay? Cool. All right, so I have a measure of trend. I'm cleaning this up for Sultan so he understands me a little bit better. Okay? You can see now there's two measures of trend, longer term and shorter term, because you can see I got something going here. Okay? Great. Oops. I killed it, right? So anyways, let's do it again. Trend, I use channels. Okay? For the market, for the measure of the market, I'm using biased pivots. So I'll put pivots. And now for price, because I want to use price action, I'm using a measure of a 5/8 moving average combination. So I have three things going on. Okay? Do you understand? I have three things on this chart. Okay? Cool. So, what I could do is say, using this chart alone, around 102, maybe 102.55. I might consider buying oil. In fact, between between 102.5 and 100. I might consider buying gold or oil. I might. I don't have to. There's more to my equation than that. Okay? So when I'm between this area, I may look for a 5/8 cross up. And I might buy that. I might buy something that looks like this. I have a general idea of price. I know what price, somewhere between 102.5 and 100. When will be determined by the 5/8 cross up, which probably will put me in around 103. Probably here, because for that to cross, candles will have to make higher highs. Okay, well, it'd have to make a low somewhere in here, then make a higher high, then make a higher low, and then probably make a higher high, and then probably make a higher low, and then probably make a higher high. Like somewhere in here, the moving averages will cross. Okay? They'll start out kind of like this. Oops. Okay? And then this one will have to go nope. Okay? and therefore somewhere in here, I will long bomb it. You see? What the most important part is, and if you don't know this, this is the piece of information that is holding you back. And I hope you hear me because I'm trying to give you value. The most important piece to all of this is that you've developed a bias. And the bias is based on your research that told you in the near future, WTI will go up. If that's what you think, then that's how you will do it. The doing of it is easy. If your bias is down, you would not do this. And I could help you predict tomorrow. How many people think oil is going to fall the rest of the week? Give me your bias. How many people here think oil will fall the rest of the week? I will then show you how easy technical analysis is. But I need to know. You need to be able to predict days and days and days of advanced future price action that does not exist. Anybody? Okay. We have one. Great. Let me help you predict the future now technically. You have some fundamental reason. Maybe some research, maybe a guess, maybe a hunch, maybe you're delusional, maybe you're a genius. It doesn't matter. Let me now show you how easy trading is. You ready? Or technical analysis will be. You either trade in the coming days a double top, or I have to back this out even further to add this. Oops. Okay. You will trade a double top or okay, let me write this out for you. If your bias is bearish, you will sell a double top or, right, a lower high. And if your bias is correct, you will make money. And by the way, I will have to shift these pivots. You wouldn't look at it this way. You'd go to the indicator, open up the bias pivots, and you would say, no, 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 no. You're a bear. Okay? And so you're going to get a double top or a lower high. And if this happens, tomorrow's central pivot will probably be there or even lower. Okay? Now, Lucas says, oil up with blah, 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 blah. Then you are a bull. And you will not think this way. And you will not plan for that, except for managing your stops. Okay? Cool. Well, I'd like to apologize. I think I've taken too much of your time today. That was almost 2 hours. But I thank you for leading the conversation. And I hope the value creation conversation added value to you, to your thinking towards trading. Please like, please subscribe, please leave a comment. If you liked how I broke down the technical analysis by removing things and adding more clarity, if you like the idea of trading as a business, if you like the idea of my business planning, please leave a comment, because maybe that will help the YouTube algorithm say, hey, you know what? This is valuable content, and maybe more human beings should hear it. That'd be great. Okay? So, peace on earth. May the pips be with you. May our profits be above average. And if you like what you heard today, you should join. Probably half the people in this room or in this live stream are part of fxbootcamp.com. You should probably visit. It's $88 a year to join. And also, many, many, many are clients of tradersway.com. So if you want an ethical, quality foreign exchange broker for your successful Forex trading business, tradersway.com. And I will see you in my live trading group today at 7 p.m. If you're in my live day trading group, you will also have pre-London. So we do pre-Asia. We also do pre-Europe. And then I'm here in New York every single day, pre-New York. So, holy smokes. Amazing, right? So I'll see you later. I'll see you when I see you. Cheers. Pacha.